I really want to talk about your expectations. Last quarter, FedEx had a beat and a raise to guidance. Are you expecting that again this quarter? What's your overall view on the stock?
FedEx is in a great place right now. They've been after the dismal Q1 2023, where they had a big warning last September. Since then, the company has been really focused on being more efficient, cutting costs, right sizing their express network, really gaining those efficiencies in ground. And it turns out that they're in a sweet spot because they've won all this business from UPS and Yellow. So we're looking for them to retain, hold on to the business that they won while they're driving these cost savings. So FedEx seems to be in a really sweet spot here, Frank.
All right, so you like the direction FedEx is going in. And by the way, you definitely have a skill in understatement. You talked about that warning last year. It was dire. CEO Raj Subramanian basically said, the entire world is just slowing down. We're on the brink of recession, which obviously didn't happen. I know you're not an analyst, but a lot of analysts have a price target on this stock of $300, about a 6% upside. It's had a huge run up year to date. Do you see more upside for this stock, or is the confidence in the transformation, the cost cutting, do you think that's already priced in?
As long-term shareholders, we actually think that finally FedEx is getting its act together, right? Becoming a lot more disciplined, efficient organization. You talked about all these savings that they're doing through their Drive program, but as we look out to 2024, June 2024, they're going to reorganize and combine Express and ground into one FedEx. And that's always been an issue for FedEx because they've had operated two different networks. So there's a lot of power to be coming from combining those networks and driving further efficiency and gains. We actually think for long-term investors, FedEx is finally becoming a lot more efficient. They're cutting back their CapEx, right? That was always a big issue with FedEx buying more planes. They're really rolling that back, being more disciplined as to how much capital expenditure they need. They're getting a lot more disciplined on their capital deployment and striking a very balanced tone there between buybacks, $1.5 billion budgeted for this year, dividends. This is a company that's given you 15% increase in dividends over the last 5 years. So long term, we still feel very good about where FedEx is going. Of course, we don't expect this to be a linear path. It rarely is, but we're committed to staying with the company here.
So I want to talk to you about shareholder return. You mentioned you're a long-term shareholder. FedEx in the middle of a $1.5 billion buyback. That has been questioned ever since CEO Raj Subramanian gave that kind of dire warning. Do you feel like that instead of this buyback, they should use this money somewhere else, maybe continuing to raise the dividend? One of the big things when Raj Subramanian took over was that they had plans, at least, to raise the dividend long-term.
Right. The FedEx payout ratio is low compared to their peers, only 20%. So there's always room to raise that, and we would welcome that. But I think overall, it's always good to have a balanced approach between internal investments to make sure that the business is meeting customer demands and it's positioned for long-term growth and sustainability, and then balancing that with shareholder returns, either in the form of dividends or buybacks. We'll take both of them or a balanced tone between them.